Are you ready to secure your financial future? You might think investing is complicated or even a little intimidating, but it doesn't have to be. Here's a fact that might surprise you. If you had invested just $1,000 in Amazon at its IPO in 1997, that investment would be worth over $1.5 million today. And that's not a fluke. Smart, long-term investing can turn modest amounts into substantial wealth. But here's the thing. Most people aren't taking full advantage of this. Did you know that nearly 70% of Americans have less than $1,000 saved for retirement? That's a shocking number, especially when the stock market has proven to be one of the best ways to grow wealth over time. The good news is, you don't need to be a financial genius to make it work for you. All it takes is understanding where to invest and being patient. In this video, we're going to explore 6 powerful long-term stock strategies that could help you build real wealth. We'll uncover hidden gems in the market, dive into unshakable giants, and explore the future of green investments. We'll also talk about tech titans, dividend dynamos, and the ever-reliable healthcare sector. Each of these chapters offers a unique path to financial security, and by the end, you'll have a roadmap that's simple to follow. Ready to take the first step? Let's dive in and discover how you can make your money work for you, setting you on the path to financial freedom. Chapter 1. Hidden gems in the stock market. When it comes to value investing, sometimes the best opportunities aren't in the spotlight. Instead, they're hidden gems, companies flying under the radar of most investors. These stocks might not be household names, but they have the potential to grow significantly over time. One great example is Monster Beverage, which was once a small company that very few people knew about. Back in 2003, the stock was trading at just 10 cents per share. Fast forward to today, and it's one of the biggest players in the beverage industry, with its stock price soaring over $50. Finding hidden gems requires a keen eye for potential and a willingness to dig deeper. You're looking for companies with strong fundamentals that are undervalued by the market. These might be smaller companies or those in niche industries. They often have low price-to-earnings (P/E) ratios compared to their peers, but they demonstrate consistent earnings growth. For instance, during the 2008 financial crisis, companies like Dollar General and AutoZone were undervalued, yet they thrived in the years that followed. It's also crucial to look at a company's management team. Strong leadership can make or break a small company. Look for management with a track record of success and a clear vision for the future. Warren Buffett once said, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." This rings especially true for hidden gems. The idea is to find those wonderful companies that the market hasn't fully appreciated yet. Investors should also consider the company's competitive edge. What makes it stand out? Whether it's a unique product, a strong brand, or an innovative business model, this edge is what will drive the company's growth in the long term. Take Netflix, for example. In its early days, it was just a small DVD rental company. However, its shift to streaming and original content gave it a competitive advantage that transformed it into a global entertainment giant. Moreover, patience is key. Hidden gems often take time to realize their full potential. Unlike more popular stocks that may show immediate gains, these investments are long-term plays. But the payoff can be substantial. Historically, small-cap stocks have outperformed large-cap stocks over the long term. According to data from Ibbotson Associates, small-cap stocks returned an average of 11.9% annually from 1926 to 2019, compared to 9.8% for large-cap stocks. In summary, hidden gems offer a unique opportunity for value investors. By focusing on undervalued, small to mid-sized companies with strong management and a competitive edge, you can uncover stocks with significant growth potential. Just remember to be patient and do your homework. The market may not recognize the value of these companies today, but over time, they could be the key to securing your financial future. If you're into this, subscribe and let's keep moving forward with the video. Chapter 2. Unshakable giants. While hidden gems are exciting, unshakable giants provide stability in your investment portfolio. These are the blue-chip companies that have stood the test of time. Think of them as the anchors in your portfolio, reliable, resilient, and capable of weathering economic storms. One such giant is Johnson & Johnson. Despite countless market fluctuations, Johnson & Johnson has delivered consistent returns for over a century. Investing in these giants isn't just about the brand name, it's about the fundamentals. These companies typically have a strong balance sheet, consistent earnings, and a proven business model. For example, during the COVID-19 pandemic, companies like Apple and Microsoft not only survived but thrived. Their solid business models allowed them to adapt quickly to changing circumstances, leading to record earnings in 2020. What makes these companies unshakable is their ability to innovate and stay relevant. IBM, for instance, has been around for more than 100 years. It started as a manufacturer of punch card machines and has since evolved into a leader in cloud computing and artificial intelligence. This ability to pivot and innovate keeps these giants at the top of their industries. Moreover, unshakable giants often pay dividends, which can be reinvested to buy more shares, compounding your returns over time. According to a study by Hartford Funds, 84% of the total return of the S&P 500 since 1960 has come from reinvested dividends and the power of compounding. Companies like Coca-Cola and Procter & Gamble have been paying and increasing their dividends for decades, providing investors with a steady income stream. It's also important to consider the global reach of these companies. Many unshakable giants operate internationally, which diversifies their revenue streams and reduces risk. Nestlé, for instance, generates less than 2% of its revenue from its home country of Switzerland. This global footprint allows them to tap into emerging markets, further driving growth. However, investing in these giants doesn't mean you can ignore the price you're paying. Even the best companies can be poor investments if bought at too high a price. As Warren Buffett advises, price is what you pay. Value is what you get. Look for opportunities to buy these stocks when they're undervalued or during market corrections. In conclusion, unshakable giants are the bedrock of a solid investment strategy. They offer stability, consistent dividends, and a track record of success. By including these companies in your portfolio, you're not only securing your financial future but also adding a layer of protection against market volatility. These giants may not double overnight, but their slow and steady growth will keep your portfolio strong over the long haul. Chapter 3. Green is the new gold. Investing in green companies isn't just about feeling good, it's about securing your financial future in a world that's rapidly changing. As the global focus shifts towards sustainability, companies that prioritize environmental responsibility are positioned for long-term growth. Take Tesla, for example. In 2020, Tesla's stock soared by over 700%, driven by increasing demand for electric vehicles and renewable energy solutions. This wasn't just a bubble, it was a clear sign that the market values companies that are leading the charge in the green revolution. The trend towards green investing isn't just a fad. According to the Global Sustainable Investment Alliance, global sustainable investment reached $35.3 trillion in 2020, a 15% increase over 2 years. This shift is largely driven by institutional investors recognizing the long-term risks of climate change and the opportunities in sustainability. But it's not just about the environment, it's about future-proofing your portfolio. Companies that focus on sustainability are often better positioned to navigate regulatory changes and shifts in consumer preferences. When considering green investments, look for companies with a strong commitment to environmental, social, and governance (ESG) criteria. These companies are not only focused on profits but also on making a positive impact on society and the environment. One compelling example is Ørsted, a Danish company that transitioned from a fossil fuel-based energy company to a global leader in offshore wind power. Since making this shift, Ørsted's stock price has more than quadrupled, and it's now one of the most sustainable companies in the world. Investing in green companies also means looking for those that are innovating within their industries. Beyond Meat, for example, is revolutionizing the food industry with plant-based products that appeal to both health-conscious consumers and those concerned about the environmental impact of meat production. Since its IPO in 2019, Beyond Meat's stock has been volatile but has also shown significant growth, reflecting the increasing demand for sustainable food options. It's also worth considering green bonds, which are specifically issued to fund projects with positive environmental impacts. The market for green bonds has grown rapidly, with issuance reaching $1 trillion globally by the end of 2020, according to the Climate Bonds Initiative. These bonds not only support the transition to a greener economy but also offer a relatively safe investment with predictable returns. However, it's important to do your due diligence when investing in green companies. Not all companies that claim to be sustainable are truly committed to environmental responsibility. This phenomenon, known as greenwashing, can lead to poor investment decisions if you're not careful. Look for companies that provide transparency in their reporting and have third-party certifications or ratings, such as those from the Carbon Disclosure Project, CDP, or MSCI ESG ratings. In conclusion, green investing is about aligning your financial goals with the global push towards sustainability. By focusing on companies that are leading in environmental responsibility, you're not just investing in a trend, you're investing in the future. These companies are likely to benefit from regulatory support, growing consumer demand, and the increasing importance of ESG criteria in the investment community. Green is indeed the new gold, and it's an essential part of any long-term investment strategy. Chapter 4. Tech Titans of Tomorrow. The tech industry moves fast, but it's also where some of the most exciting long-term investment opportunities lie. Investing in tech titans of tomorrow isn't just about following trends, it's about identifying the companies that will shape our future. One of the most famous examples is Amazon. What started as an online bookstore has grown into a global giant that dominates multiple sectors, from e-commerce to cloud computing. If you had invested $1,000 in Amazon's IPO in 1997, your investment would be worth over $1.5 million today. But how do you identify the next Amazon or Google? One key strategy is to look at companies that are solving problems in innovative ways. For example, Square, now known as Block, revolutionized the payment industry by enabling small businesses to accept credit card payments through mobile devices. Since its IPO in 2015, Square's stock has increased by over 1,000%, reflecting the growing demand for digital payment solutions. Another strategy is to focus on companies that are leading in emerging technologies. Artificial intelligence, AI, for instance, is set to transform multiple industries, from healthcare to finance. Companies like NVIDIA, which started as a graphics chip manufacturer, have become leaders in AI technology. NVIDIA's GPUs are now essential for AI research and development, driving the company's stock up by over 5,000% in the last decade. It's also important to consider the scalability of these companies. Tech companies with scalable business models can grow rapidly, as their products or services can reach a global audience with minimal incremental costs. Zoom Video Communications is a prime example. During the COVID-19 pandemic, Zoom became a household name, with its user base growing from 10 million daily participants in December 2019 to over 300 million by April 2020. This scalability translated into significant stock price growth, making Zoom one of the most talked about tech stocks of 2020. Don't overlook companies that are quietly dominating niche markets either. These companies might not be household names yet, but they have the potential to become leaders in their specific areas. Shopify, for example, has become a dominant player in e-commerce platforms, especially for small to medium-sized businesses. Since its IPO in 2015, Shopify's stock has grown by over 3,000%, thanks to its focus on empowering entrepreneurs and small businesses. However, investing in tech also comes with risks. The rapid pace of innovation means that today's tech darling can quickly become tomorrow's has-been. That's why it's crucial to look for companies with a strong vision for the future and the ability to adapt to changing market conditions. Microsoft is a classic example. After falling behind in the early days of the internet, Microsoft reinvented itself by focusing on cloud computing with its Azure platform. This pivot has driven significant growth, with Microsoft's stock more than quadrupling in the last 5 years. In conclusion, the tech titans of tomorrow offer some of the most compelling long-term investment opportunities. By focusing on companies that are solving problems, leading in emerging technologies, and demonstrating scalability, you can identify the next generation of tech giants. These companies may be volatile in the short term, but their potential for long-term growth makes them an essential part of any diversified investment portfolio. The key is to stay informed, be patient, and invest in companies with a vision for the future. Don't forget to subscribe so you never miss an update from us.